Habari and Shikamo. Karibu Sana, welcome to this Turn Up Financial Thursday edition of my financial series, Assets Not Liabilities. I am your host, Alonzo, aka Real Talk, the certified financial specialist, book learn, and self taught. Today, we're going to talk about fractional reserve banking. This is brought to you in part by Premier Executive Financial, a Premier Executive Group company. Without further ado, let's jump right into it. First, what is fractional reserve banking? Cool. Why is it important? Cool. Those are good questions. About to explain it to you right now. So let's say that's you. Okay, here you are. Y'all happy? And let's give you some legs, give you some arms here. All right. Definitely skip leg day. That's okay. And here's your check. You got a check and you're headed to the bank to deposit it in the bank. Here's the bank, and here is 1,000. Here is 2,000, and here is $3,000 that you're going to deposit into the bank. Okay. Now let's annotate that down here. You just put $3,000 in the bank. Got it. And the federal government say that a bank can lend a percentage of that money that you put in there. So by law, they can keep in reserve within the bank 10%. 10%. The rest they can lend out to someone else. So we look at 10% of 3,000. What's left is $300. $300. Now, don't be alarmed. They're not actually taking your money, okay? They are just lending your money. So all of this still equals $3,000. So you still have access to 3 grand, okay? They're just banking on not everyone is going to come in there at the same time to withdraw all their money. Okay. So what does that leave them with the ability to loan out? That's $2,700 that they can loan out. So now let's take a look at what they give you with your $3,000. $3,000. And let's say you put it in a savings account, which we discussed the other day. We looked up the rate for Citibank savings and it came up to 0.04%. And let's say you leave it in there for 1 year duration. All right, so if we did some math here, 0.04 times 3,000, 4 times 3 is 12, so you're going to earn $1.20 APY, annual percentage yield. So that's what you're going to get. You put 3,000 into this bank. All right, fractional lending or fractional reserve banking is the bank's ability to reserve some of your money, 10% in this case, comes up to 300 in this case, and lend out 27. So they're going to give you some money to do this. They want to. They want to pay you so you can put the money in that bank. So here you go. You got your $1.20, but you can't forget about inflation, right? Inflation, based on the other video, we looked it up. It was at 0.1%. So we got 0.1%, which equals, in this case, 0.1% of 3,000. 1 times 3 is $3. So $3. So in actuality, when we talk about buying power, remember from the previous video, that is what is important is our buying power. That's what we're worth and what our money is worth, really. So when you talk about buying power, you really lost some money. So you earned $101.20, but due to inflation, you lost $3. So technically, it's negative, what's that, 180 $1.80 negative right there. Okay. So let's make this bigger so you can see exactly what I'm talking about here. All right, sorry. Let's go ahead. We make all of this bigger and you'll see here. Okay, so recapping, you put 3,000 in, 0.04% 1 year. You earn $1.20 due to inflation at 0.1%. Cost you $3. So really you're negative 180 in buying power. That's all from putting your money in a savings account in this bank. With the bank participating in fractional reserve banking, they can loan your money out. So now let's see what that really looks like and why that's important. Why you really care about it. Why should you know about this? And if you never heard of it, why didn't you never heard of this before? Why has no one ever told you this? Yeah, exactly. Maybe when you see what I'm about to do, you're gonna realize why they don't want you to know this, right? So here we go. We got 2,700. So the bank goes ahead and loans your money to someone else. That's right. They loan it out to somebody, but this time they are getting a good deal because they're loaning this money to this individual and they're gonna loan them $2,700, which is your $2,700. So this is why it's good for the bank because they haven't even touched their money yet. They don't even need to touch their money yet. All I got to do is pay you a little $1.20 to give me $3,000. So then I loan your money somebody else to make interest. Okay? Y'all ain't feeling me yet, but y'all about to. So this person here, bank says, okay, here's your money, 2,700. I don't know what happened there. All right, let's get rid of that. Bank says, yo, here's your money, $2,700. Have at it. Do what you got to do, right? So this individual is going to get charged interest because that's what the banks charge people. All right, I'm going to lend you this money, which, by the way, is not the bank's money. It's your money. I'm going to lend you this money and I'm going to charge you. All right, and let's just say this person had somewhat decent credit, okay, decent income, and they are going to get it at, and I'm being real reasonable, all right, just to be facetious, but they're typically higher than this. We're gonna say 8% interest is what this person's gonna get charged with. They got middle of the road, kind of low credit, all right, let's call it that. So at 8% interest, and then we could do compound interest, right? We're gonna do duration 1 year. Let's just say the individual got the loan for 1 year. We're just keeping it simple and pay it back. Okay. Typically, you're looking at 24 to 36 months. All right. So now, how do we calculate the compounding interest? Because you got to understand how compounding interest works. And typically, it's a daily incurral rate. Okay. Or monthly. All right. But there's more days if I go by days. So I get a little bit more money out you. It's no secret. Okay, it's all math. It's no different than making an extra, paying your mortgage twice a month. Okay, you actually throw another payment in there by the end of the year. So same concept, all right? So if I'm charging you interest, I'm going to try to get the most out of it. So I'm probably going to incur, or your money, or the loan that I loaned you is going to incur interest each day. So how do we do that? I know a lot of y'all out there is like, you don't know much about finance. You don't know nothing. Well, let me show you something. All right. There's a formula to determine the compound interest or your APY. All right. And it's 1 plus R divided by N and then N squared minus, look, I don't know. All right. Who does compound interest in their head? I don't know the formula. No, you do like normal people. Go to Google and you find a compound interest calculator and you can figure it out. Or you just look at your amortization schedule and it'll tell you once you get the loan. So no, but I do have my own proprietary formula that I use. Okay, and it goes like this. We take the loan amount, $3,000. We times it by the percent. So they're charging this person 8%. Then we're going to divide that by 2. And then we're going to add my own proprietary way here. Every 1,000, I'm going to add about 5. So we're going to say 15. Boom. $135. Now, if you don't believe me, go look it up. I bet you that's close, right? So we come back here and we say, guess what? I'm gonna give you that 130. I'm gonna give you that $2,700, right? But you're gonna pay me $135. $135. Now, of course, banks got inflation too that they have to worry about, but we're not even going to talk about that right now. $135 on your money, and they gave you $1.20. Come on, y'all have to learn this stuff. You gotta know. You gotta know how these banking things works. Okay, they make money off the interest. Let's just be honest. Okay, banks are profit. Now, when you're talking about credit unions, we're talking banks. Banks are profitable organizations. The whole point of a profitable organization is to turn a profit. Hey, they can put all the slogans they want. That's it. It's business. This is business, baby. All right. So now, what do you do with this information? You're armed with, and you see firsthand what fractional reserve banking is and why it's important for a banker. So it should be important for you because that's your money. That's your money. It's $2,700, right? $135. Now let's just say you put your 3,000 in a different vehicle, same bank. Okay, so the bank's still gonna do the same thing. All right, but you put it in a CD. Now, let's say in a CD, they're going to give you, let's say 1.50%. Okay, 1.50%. Now let's do some math. So you got $3,000 and you are going to get it at a rate of 1.50% for 1 year, right? 1 year. What does that come up to? 3,000 times uh, 1.50. Let's go back to the calculator. Okay, so we got 3,000 times 1.5%, $45. $45 you're gonna make. So equals $45. No, that's not right. Let's get rid of that and let's get the right number up here. $45. Now I'll tell you this, $45 is a lot better than $1.20 that you earned up here in that savings. So for those who were just curious on moving money into what vehicle, that's just something for you to think about right there. All right, leaving that money in there, you're under inflation, you lose buying power, and you only was getting $1.20 anyway. In the bank, it's getting 135 off of you. So at least this way, putting it in a CD after 1 year, at least make $45. Now that is about 45 times greater than what you just had. Okay. Now I still don't compete with the bank's $135. So now, knowing what fractional reserve banking is, knowing why it's important to understand why or where your money is at and why. Now the question is, what do you do about this? What do you do with this knowledge? And most people, if they haven't talked to you about fractional reserve banking, they may have told you what it is, but what's the so what? How do you get around it? Well, right now, 8% is pretty good. There's not a lot of vehicles out there that's going to get 8%. I mean, the highest, and for my military personnel, as USA or Navy Federal Credit Union, Navy Federal provides really good rates on CD. Okay. Again, I don't get paid. I'm not endorsing them, not sponsoring them at all. Now, Navy Federal, you want to throw me that check? Please run it. I will sponsor and endorse you. But what I'm saying is, I'm using you as an example to show how those who are members of those institutions, those credit unions, can get access to 3.5% on a share savings certificate, 12 months. Okay. Now that's probably the highest you're gonna find out there, and that's real good. That's real good. So 3.5. You're looking at doubling that. You're looking at $90. That's what you're gonna make. Okay, off that CD, $90. Now that's real close to 135 than that $1.20 was. So we went from $1.20 in a savings, okay, in a bank, Citibank, excuse me, and then we went to $45 in a CD at a commercial bank, okay, all the way up to getting a credit union if you could get Navy Federal, and we're making $90. Boom. All right. So we're doing good, but we still ain't beating what the bank is making off our money. They're still making 8% off of it. So what's some other options? Okay. Here's some other options. And I know all of you are probably saying it, chomping at the bit to say it. That's right. Stocks. Stocks is probably the next highest return investment. However, it's also the most volatile. It's the most high risk. Okay. But what I want you to do when you do your research and when we make a video of it, I'm gonna talk more in depth, but I want you to think about two different types of stocks. Okay, common and preferred. Now I want you to do some homework and you tell me which one is more preferred. That was my hint. Okay. Another vehicle that we can look at too is dividend stocks. That's a D and that's a V. I don't know what's going on here. Dividends. Okay. Now, when you do your homework, there's two different types of dividends you want you to look at. Okay. You got qualified dividends, and that's supposed to be a D, and just regular dividends. All right. Got a video coming that's going to talk about that. And this last one that I'm going to talk about, which I'm going to go a little depth here, but it's going to be in this next video that I'm about to talk about. And I'm just going to pose the question. Okay, I'm going to pose the question to talk about it briefly. Then I'm going to go in depth. What if you took your 3,000, okay, instead of putting it in the bank, okay? What if you could take your 3,000 and you can become an investor and you can lend it to a borrower? Here we go. You lend it to this person here. Look at him. He's happy. She or he, either way, they are happy. Yeah. You lend it to them, and based on this lending protocol, you're going to make at least 8% off of that. Okay. So you make 8% off of that 3,000. We did it up here. 8%, 2,700 was $135. So you're already going to make more than that. But let's go ahead and just do the math. So I want to show you. I want to show you what this looks like. So we go back to the handy calculator here, and you're going to be charging them interest, compounding interest, okay? Because you're a lender. So you take 3,000. Let me do my proprietary compounding interest calculation, okay? Times the interest rate. You're going to be charging 8%. Got it. Then we're going to divide that by 2. Got it. And we're going to add my proprietary way of doing it. 5 by 1,000. So that's 5, 10. Let's add 15. $15 to that. Look at that. Boom. $135. So you just made what the bank made. And you cut the bank out. I don't know what's going on there. But that's what we're going to talk about in another video. All right. I know you want to know what that is. But we're going to cover it. Okay. We're going to cover it in another video. I appreciate y'all tuning in. Thanks for watching. Stay tuned for more videos. And yeah.